Right. Well, why don't we work through our little agenda? And I think
Right.
the first question or the first bit was really obviously we know you guys, and I think we've been with you for a couple of years, and we're very pleased with it. But maybe you could just give us a little bit of background of where Dundas Partners has come from and why.
Well, James, thank you very much. Thank you very much for everything, and that includes this morning. And it's been a pleasure seeing you already, and I'm delighted to do this, and I'll be happy to do it again. I left university in 1978. I did a 2-year stint in local government, another day, another discussion on policy work, which was interesting but slow. And so I joined this industry in 1980, so I've been doing it for 42 years. The first part, the very first part, those on this call who are old enough to remember the Thatcher, Geoffrey Howe era of the ladies not for turning and the tightening upwards of interest rates will remember that was a moment, not just in the UK, but in other advanced economies that were dealing with structural inflation for the 1970s. So that's where I cut my teeth. And my experience of folks in our industry is that we're always coloured by that. And my first investments were in private companies in a thing that's now called 3i, had a different name then. But it invested in small UK companies, private companies all around the UK. I worked in the Edinburgh branch. And the point is, when we invested, there was no market. We weren't looking at stocks and shares. We were looking at the business and its prospects and its financials and its management. And the question always was, if we invested or lent them money, how would it come back to us and how would they thrive and prosper to give us a good return? And indeed, when I moved over to the listed markets, it was at the invitation of a wonderful man called Ian Rushbrook, that some of you might have heard of, who used to be the manager of Personal Assets Trust. And he invited me to go to Ivory and Simon. Essentially what he said was, take that approach, but apply it to listed companies where the share price moves every minute. Because the firm he was at, Ivory and Simon, was very much a fundamentalist firm. And really the story of my career until we're speaking now has been about doing those things. The focus of my attention, and I was very interested in your website about your paper on DB transfers, is the bulk of my career has been working with DB pension plans for most of it. We still do that just now here in the firm today. And then laterally with defined contribution pension plans in Australia. So I'm just telling you what a wee boy from Glasgow has done. But I mean, I've worked with clients in the South Island of New Zealand, all the way to Vancouver Island, not through the Pacific, the other way, and as far south as the south of New Zealand. In fact, I think is New Zealand further south in South Africa. I worked with a pension plan in South Africa, and then all the way up to clients in Sweden, and all points in between where we decided to fund our retirements. We decided to set money aside. And what that job is all about is matching today's deferred income. So money taken out of your wages, and your employer puts some in, and they put them into this wondrous machine called a pension fund, which mostly doesn't pay tax. Gordon Brown changed that a bit, but it mostly doesn't pay tax. So all the dividends and rents and interest payments are compounded. So I did that for 30 plus years. I was the chief executive of a firm in Edinburgh that had grown out of Ivory and Simon. I was the second biggest shareholder, and that firm was acquired initially in 2006, and the financial arrangements worked through 07, 08, and 09. Some of you might remember that was a wee bit tricky, but it worked out well. Our investment performance was good, and that put me in a position that I could take a step back and think about what to do. Now that's the unimportant bit of this. So the important bit is why Dundas. And I noticed that you were formed in 2009, so actually we're about the same time. So the first baby boomer was born in 1946. And he retired in 2011. Now, along the way, a lot of she's joined the workforce and joined the pension system. So the pension system just expanded, and it's still the biggest savings collection and concentration in the world, although we now have SIPs and personal pensions and so on, but that's the bulk of it. And if you look back over that period, that's been the period in which our investment management industry has expanded.
Yeah.
But it's faced with a new challenge because of the retirees. Because the retirees will be consumers of savings, not compounders of savings. And I was and remain fascinated by the implications that will bring for investment markets, not just for the individual drawing down his or her SIP advised by someone like you as to what to do and where to do it, but what does that do to markets? Because we know what the first 1946 to 2009 phase did to markets. What does the next phase do? And that's why we started Dundas, was we thought that investment behavior would need to change, because every time someone retires with £500,000 in their SIP or their workplace pension or whatever, someone said to me, yeah, but somebody joins at the bottom. Yeah, but look, something's happening. So the tilt is very swift. And there's lots of data online about this. Now, I think broadly we've been right about those questions and what they carry for investment. A bit swamped by super low interest rates, recovery since 2009, technological questions and so on, none of which are contradictory, but they sit alongside. So what's the big insight? This is my 3 points about how did I get here. We took our time to look at how do returns develop. And the biggest contribution to return for your clients at Tideway who are sub-retirement age is compounding. It's true of everybody everywhere in the world, it's compounding. It's the internal compounding inside the companies you select, and it's the compounding of the dividends and the capital gains back into that portfolio. But when we retire, our inner actuary says, well, if I've got £500,000, most of us are some of us are okay spending capital, most of us are a bit leery about it. Because although I'm now in my 60s, rumor has it you may or may not be, but I'm in my 60s. The longevity of the generation before us has extended enormously. So now people in their 60s are long-term, multi-decade investors.
Absolutely. I was going to say it, but you've said it before me, Alan. I mean, it's you've still got a 35-year time horizon potentially. And in fact, now with pension freedoms and these accounts being handed on, it's almost an indefinite time horizon for a lot of people. So,
well, I'm wrapped up in what I do with Anne and I have a charity that we funded. We have grandchildren we helped to fund. There's the business of Dundas. All of these questions are relevant, but the central one is how do we put bread on the table for the next 30 years? And at some point, I guess, I'll still be an earner or a profit sharer. And at that point, the great majority of us are left with what's in that SIP or what's in that DB plan. Now, if you're lucky in a good DB plan, someone takes those decisions for you and sends you a check. So my dad was a financial illiterate. He retired in 1979, he got a gold watch, and he got 2/3 of his final salary from being a foreman on a cardboard box factory line. And my mum then inherited half of that plus her NHS pension. They never had to think about money. That's changing.
Yeah.
Because people aren't getting those benefits. So what's the key investment message? Well, I won't pretend to answer that question and say there's only one, but here's one that's important. When you stop compounding, your £500,000, let's say there's a 1% yield, just to make it simple. So you get £5,000 of dividends every year. For the prior 40 years, that was automatically reinvested. If you can live on £5,000 a year, you don't have to touch the capital. And if the £5,000 rises faster than the inflation you experience, whether you shop in Waitrose or Tesco Value or Aldi, wherever you live your life, if your 5,000 goes up faster than that inflation, safe.
You're done.
But for most of us, 35-year inflation compounds are mind-bogglingly complex to imagine. We can't discount that far ahead. But the key thing is your dividend is a separate return stream from your capital. And dividends don't come through the stock market. They come through what I learned between 1980 and 1983, working for 3i's predecessor. You invest in the companies and they send you a dividend, and maybe you can sell the shares at some future date. So the short answer to your question is, my career has been institutional until we started Dundas, and we started the Harriet Fund. Apologies for the name confusions. We may resolve that, but we'll get that. That's another day. But the Harriet Fund is the thing to focus on. And it's intended, it is not exclusively intended for retirees. That would be facile. But it is inspired by the mutual insights that I think you and I share.
Yes. Yeah. No, I think we're dealing largely with what we termed a phrase irreplaceable capital, and I think that's the point you mentioned there. When you flip from having earnings and you can always keep investing more if the markets go down, to being in a situation where you have a finite piece of money and that's got to put food on the table, as you say, for the next 30 years. So that's the business we're in, is making sure that happens. That's good.
Actually, just one final point on that. That 1946 birth, and the data, the best data on those folks is from the USA, because they're quite obsessed with them, and all sorts of generations and so on. We're not quite the same here in the UK, but largely those boys came home, and the GI Bill put lots of them through college and so on and so forth. By the time they hit their stride in the 70s, their incomes were under great pressure from inflation. And I think it was Jimmy Carter sent Paul Volcker to the US Treasury, and bond yields hit 16.
Yeah.
Today, you're getting that $500,000 at effectively zero, but negative bond yields, because even 2% inflation is higher than we get. So this conundrum, and I'm not shooting you a line, James, I'm glad you do your job and I don't have to do it, because putting that together in a diversified portfolio for a client
is tough.
That's a big job.
Yeah. No, I mean, real gilt yields have probably never been so negative, right? Because even though we had a period where gilt yields were almost zero, that was against a backdrop of pretty low inflation. Now we've got gilt yields of 1.5, but inflation, depending on which index you take, is probably 5 to 7. So we've got a massive gap between inflation, and we're going to come to inflation at the end of this piece. So maybe the next thing really would be we've identified it's, for those who are not familiar with it, it's a global equity portfolio that you're running. How would you describe the philosophy and the strategy of picking the stocks? Why, you mentioned you just do stock selection. Why do you own how many stocks is it? About 40 stocks? No,
we're about 70 in the
70
fund, and about 70 in the Global Smaller Companies Fund. So
how do you pick those 70 out of all those stocks?
Well, let me give you some numbers that I hope are going to be useful. FTSE and MSCI both promote indices that make a fair representation of global market capitalization. And we tend to use the MSCI ones. You can get them for free online. Just type in MSCI All Country World Index and you get the fact sheet. The fact sheet's produced every month, and it tells you how many stocks are in that index. Now, my understanding is they don't do full replication. There's a bit of statistical sampling at the bottom. However, 2,500 to 3,000 stocks, 2,500 typically, are in that index, and I think the FTSE one is the same. Now, that's about 83 to 85% of global market cap. And the next iteration, which is the smaller companies universe, is another, I think to get the next 10% or 13% of the world index is about 7,000 stocks. So it's Apple sits at the top and all the way down to tiny little companies. So our job is to work out, so why do we have so few? We could go on about this for ages, maybe another call. But the world is very different than the industry is a very different one than the one I entered, which was information dry. And we were essentially hunters. We were out looking for information, visiting companies around the world. All changed. Every company's got an investor relations website. Almost all of them are in English. They are rich in data. And so the discovery part of the job is gone. And the indices are very, very good at taxonomy. So if you look at the consumer discretionary subsector of ACWI, it's all the stocks where we get to spend our surplus money, not our consumer staples where we have to spend the money. It's very well organized. You see, in finding them is not a question. What is a question is, how do you be Vanguard's index fund?
Yeah.
Because now it's possible to say, well, I believe that the indices, all the academic work, London Business School's academic work, Morningstar's work, everybody's work on how the indices perform includes everything. And people can go and buy these indices cheap as chips. So the vanity of someone in my job is to say, well, we think we can do better. And we're not doing better by creating new things. We're doing better by elimination. So our 70 is about 2% of the opportunity set. And what I would guide you toward, James, is that our primary task is to sift out that which will not sustain that 10 to 30 year retirement. So that observation about retirement is not an irrelevance when we're doing stock selection. It is central to it. So what we're looking for are businesses that have sustainability.
Yeah.
Very modern word.
Yeah. But you're talking about sustainability in terms of the business being able to keep in business, keep growing profits, keep paying increasing dividends.
I would even go further. We think about two fingers coming together. Supplier, customer, invoice, exchange of goods and services. If we can't understand that, if that is inexplicable, because that is the essence of a free market. I freely choose to buy actually, I don't freely choose to buy these specs. I choose the optician. They choose the specs. But everything else is freely chosen. And Adam Smith's great insight is that that is the greatest wealth creating engine conceivable. And so what we're looking for are companies, limited liability companies, that we can buy their shares on a stock exchange, whose businesses do more and more of that every day at good pricing power and cash generation. So the 98 elimination job, now it's easy on the first 20, 30, 40, 50%. It gets harder because there's a lot
tougher as you narrow it down.
Exactly. And some of the most interesting discussions inside the building are when we're comparing two very fine things, better, worse. It's intriguing. And beauty sometimes is in the eye of the beholder. So our job is to narrow down to the few. I think it's liberating. So we're standing in the marketplace saying, with our own money, we could invest in Vanguard and take more holidays. But I enjoy the work. I find it fascinating. I don't want to be watching the ringside fight between the boomers and Gen Z as to who gets the allocations and how does tax policy work and who's going to invest in what companies. I want to be in the ring. So we're in the ring because it's a vocation. We really enjoy it. And we want to give clients, I mean, you know this better than I do, 0.5% per annum after fees, better than the index over 20 years. Mwah! You've solved your clients' problems.
Honestly, if you can cover our fees, Alan, that's
yeah.
I mean, we loathe to charge people because we obviously understand that, the less everybody charges, the more the funds will grow. But if you can accept that somebody like you can, on average, put back in even just 0.75% or 0.5%, that covers most of our costs, and then then they're getting the advice for free, which hopefully they find valuable. I think they do.
Indeed. And so the question is, what is the game? Now, I don't gamble. I don't go to casinos. A lot of my friends use that vocabulary. I struggle a bit to find a vocabulary that matches it, but it in essence, it's a game of elimination of. So, for example, just take this discussion about Unilever and mayonnaise with purpose, which was genius. And now we've got Nelson Peltz in. Unilever hasn't grown its revenues for the last 10 years. Now, some of that's disposals. Hindustan Unilever, the biggest jewel in its crown, which is the Indian version, which they own a majority of, not growing so much either, despite the Indian economy. And there's great questions when you walk down. So whichever supermarket you go into, James, whether you walk down Waitrose or an artisan grocer, you get one around the corner, or all the way down to Aldi, it's like trench warfare in World War I. So the retailer needs the margin, and the people making the Ben and Jerry's need the margin, but they need each other. And the question is, how are those distribution channels emerging? How does that profitability develop? How powerful are the brands? Were they a thing forever, or were they a thing for a period? Fascinating questions. Unilever's grown its dividend for the last 7 or 8 years at 7% per annum because it's been increasing the payout ratio. So it now pays out 85% of its earnings. It's becalmed. Now, there may be some short-term value in it if they break it up and this bit's more valuable than that bit. I get it. Not interested. What we want to be investing in are things whose daily events are not 0% per annum, but are 3, 4, 5, 6, 7% per annum. And what's that? Well, these lenses come from EssilorLuxottica, which is the world's biggest producer of eye correction lenses. Or they come from Alphabet, that posted extraordinary numbers overnight in terms of its search business in the last 12 months. Or from Louis Vuitton Moet Hennessy, there may not be much pricing power at the budget end, but OMG, there is a lot at the luxury end. So what we're trying to find is, I always hesitate to say this in public, but I usually do it. We don't find the stocks, they find us. So if you sift and sift and sift, so those of you who know what a riddle is,
yeah,
not much of a gardener, my dad was, and he had this circular thing and the grid, and he used to riddle the soil. And
we baby boomers know from our parents. I remember my father.
Exactly, they had allotments and things like that.
They did.
So we have Waitrose, they had allotments. We're just riddling. And you have to be confronted by what you discover. Don't approach it with an ex-ante assumption that you know what you're looking for, because that's what you'll find.
Yeah.
What we want to do is look at all of it, riddle it, and see what's left, and see if we can build a portfolio from it.
Because that's, there's 3 really classic examples there that you just came up with, and just recount them for us. So you've got a lens maker, you've got one of the, the big search engine, Google, and the third one you mentioned was
Louis Vuitton Moet Hennessy.
Louis Vuitton, luxury goods, absolutely. So that's that's a good description of what's going on in the fund. It's not sector specific. You're free to pick whatever you want. You're not being geographically limited in any way. You're not saying I want X% in the US or Y%. You're just looking for these companies that pop out of the griddle at the bottom. That's a nice description.
Exactly. And if that sounds simple, I'll take it as a compliment, because the hardest thing to do is to cut through all the modern portfolio theory, all the style boxes. They're all useful. I am not belittling them. But
so there's a couple of points that come from that. Moving on, Alan. So, the first one is, does the griddle look any different post-COVID than it did pre-COVID?
Yes.
The shapes of the holes, have they changed?
Yes, great question. Let's just talk about COVID for a second. You talked about your fortnightly letter to clients, which I hope I can start getting.
Yeah.
COVID was a nature intervention, whereas the recessions that you and I have lived through have largely been monetary policy or bad credit decisions or various other things, oil and gas. Or
you might even say it was entirely self-inflicted, in so much as one could have ignored it, and a few more people may or may not have died. But it has been inflicted not just by nature, but by the reaction of societies to the. I don't want to be too political, but
Well, I don't think you can be too political about this, because I think it's an intensely political question, and the way you framed it would certainly lead to a good chinwag in the pub on Friday night. But it would also stand as, what's the right public policy stance next time around?
Yeah.
And the way the Swedes were treated, the way Jacinda Ardern was lionized, given time, all of these things are coming down to really very similar numbers about outcomes. But there again, you see, you were talking about our parents' generation. My arm bears the scars of the immunizations I was given in the late 50s and early 60s. And my parents, who lived through a much nastier world of infection, would never cross their mind to do anything other than to vaccinate a child.
Yeah.
But here today, we have perfectly sane people, otherwise sane people saying, I don't want to do that. So I don't think it's contentious to say there was complacency. However, back to the investment question. So that griddle was, so if you looked at IATA, the International Air Travel Association, which is the most glorious website, replete with wonderful data and charts on long-term trends of aviation around the world, both individuals flying and cargo. All those trends were upwards, there were bumps, but everything went bottom left to top right. And that's changed out of all recognition because of what happened. And one of the things that showed us how bad this was looking at the IATA data sets in January, February, March, and April of 2020, because the Chinese effect was picked up very early in Asia with a collapse in air travel. So, and that goes back to one of the things about our job is not so much discovery, it's more getting access to the information that can help you take decisions. I think where the griddle has changed, or I expect the griddle will change, which could be contradicting myself a bit, don't prejudge. But I think what you said is the centerpiece. Public policy and healthcare will not be the same in future.
Yeah.
And that will have implications for testing. That I don't mind telling you, and there's no shame in this. Two of the stocks that we owned going into this and own today are Roche from Switzerland and Abbott Laboratories from the USA. And if you look at our research and our internally generated material in both companies over the 7 or 8 years we'd owned them, in Roche's case, a lot of the attention was focused on its oncology business because Roche, well, I think it was the 10 years ended 2019, had spent 100 billion Swiss francs, so call it $100 billion on R&D and capital expenditure. It was a thing to behold. And all of that was directed towards big oncology groups that they reckoned they could make a big difference to our lives. So we talked about Roche, all of our discussions were about that and so on. And with Abbott Laboratories, it was restructuring after splitting from its ethical pharmaceutical business. 25% of both businesses is medical testing. And we had treated it as the rump. So you learn as you go. And so that has changed.
Yeah.
And there'll be a step change in laboratory management, testing management. And we're seeing that as we're using, interesting, maybe in Glasgow they were called riddles, and maybe in London they were called griddles. But anyway, those things that you shook, I think we're seeing that now. And there may be changes long run in travel and tourism because all these questions about how do we control our emission rates and so on, those are changing. And in the middle of all of this, there's been an electric car boom. When I read something in the FT last week, I didn't check it, but it said that in December, unit sales of EVs in Western Europe exceeded diesels. Now, I'll believe it, the FT wrote it, I need to go and check it. But so COVID, so it's not just COVID, James, it's COVID and lockdown.
Yeah.
And it's changed the way we work, and it's changed, sales of ties in Jermyn Street. When I used to work in St. James's Street, one of my pleasures was to go out on a Friday lunchtime and sample the products for sale in Jermyn Street. They're not selling as many of those. Now, these are trivial points, but they add up to shift. It's been an
accelerant in the way things have shifted, isn't it?
Yes.
I've just looked back at the last 2 years, and the only suits I've worn have been dress suits for black tie occasions. And I wanted to buy a new one the other weekend, and they'd sold out. So I haven't bought an ordinary business suit now, but I still like to occasionally dress up for a black tie. But all those sorts of things have accelerated.
They've all accelerated, and but societies are always changing. Tastes are changing. Yeah. Consumption patterns are changing. You asked, will the griddle be different because of COVID? The answer is yes, in healthcare and many associated areas.
Yeah.
And so what will happen is, as we do our sifting and our riddling in my term, we're going to see different things sifting through. I'll give you one example. And I don't know enough about this, so maybe we shouldn't speak, but it's fascinating. So many moons ago, there was a French electronics company called Thomson, and it merged with something, and I think its name was called SGS Thomson, or SGS may have been an Italian business. Anyway, both involved in semiconductors, and the French and Italian governments shoved them together. And it's a business called ST Microelectronics. And we looked at it a few years ago. It made a lot of losses in 09-10, a couple of times after that. And it was a bit of a sort of European champion. There was always a question, was it where its products bought because the French and Italian governments lent on the car industries and others, defense industries, aviation industries, to buy them? Well, not anymore. I mean, their numbers last year were wonderful. And it's the trends, some of the trends we've just been talking about are what they're talking about. So analog chips, human machine interface chips, the automobile industry, and they were the industrial, the Internet of Things is the shorthand, but it's a lot behind it. So there's something that is booming because of the changes you mentioned, the accelerants, and the context in which that happened. So we're looking at it tomorrow as part of a research meeting. And after this, I'll have to go and brush up what I'm going to say about it. But it's fascinating to see that change. And some of that is external to them. It's things that have happened to them, but it's also things that they have done to improve their operating structure.
So, I mean, we talked about how the shifting of the companies or the sifting of the companies might change, but I think the other thing that I've heard you opine on before, and I think it'd be really nice for our customers to hear you talk, is around volatility. So, you know, obviously with the COVID dip in March 2020, we had enormous, I think that's the biggest, actually 1987 was pretty big in both directions very quickly.
Yes.
That was a similar sort of, you know, if you blinked in the middle, you would have almost not even noticed it was there. And 2020 looks very similar now in hindsight to 87. Now we're undergoing some again. I mean, what do you do as a fund manager? Do you do anything during those periods of volatility? And what would you say to our customers?
Well, let's define our roles here. Because the last part, you said, what would I say to your customers? The only thing I can say to your customers is tell them what we do and why we do it. And then if you'll forgive me, I would the way I've described people who have your role is that you're like a child with a Lego set. Now, the modern Lego sets come to build a thing, be it a Star Wars thing or a toy car. The Lego sets I got as a child where you had to invent something. So our Lego brick is available to you to work out where it should go in client portfolios, if at all. So my job is to tell you what our Lego brick does. We stay fully invested. We don't trade very much around those periods, but we don't trade very much anyway. And what we trust to is that economies, so we look at history. There's always a question about buying in the dips and when will 1929 come along, and it was a horrible period. And from 1949 to 1979 was the worst ever period for bond investors. I think they lost, well, in real terms, US Treasury investors lost something like 80% of the value of their investments. Don't hold me to that. It's just a top of the head recollection. I need to check it, but enormous amounts. So why are we fully invested? We're fully invested because the companies we're investing in are in the parts of the economy where demand is rising and consumer and industrial and government preference is moving towards them. And they're innovating and bringing products forward, like Abbott Laboratories and Roche in testing, that more people will want in future. So what we trust to is that what Adam Smith called that propensity to truck and barter, that propensity to trade. So whether it's the Arthur Daly dodgy salesman with a velvet collar and the Trilby, or somebody working in the black economy, or somebody running BAE or ARM, or any of these things, what all of us are doing is trucking and barter, and we're exchanging goods and services that we need for the resources we have. We trust that that will continue. And we trust that being involved in companies who generate cash, who have pricing power, profitability, are not excessively borrowed. Debt is your enemy. I'll give you the best answer I can give you is, and forgive me if I'm saying something here that may cause mild offense to some people. I'm being quite serious about this. I paid off the first time I ever had any money. I paid off my mortgage just before I was 40, and I've never borrowed a penny since. And the reason for that is I live in terror of the downside risk from debt. I don't want to think about it. Well, I bring that to the portfolio every day. So what I want is that we're in things that are buoyant and wholesome and going, that have forward momentum because their businesses are growing. It's an unfortunate fact that we need more and more ocular lenses because the population is aging and more people need help with their eyesight.
Yeah.
But what a great thing to serve them, and what a great thing to invest in the company that serves them, and what a great thing to benefit from it. That's the system. I glory in it. I think all the other systems are terrible. So I think the great thing about ours is that we can do that.
Yeah.
And so that's how we approach volatility. Now, that's what our Lego brick does. I've looked at I get involved with other portfolios for charities and other things where I help in the investment policy. And I can see why people invest in bonds and invest in these things called alternatives. I get it. I have nothing to offer because I've never invested in them. All I can tell you is what our Lego brick does. And the longer we have a track record, it's possible to infer the patterns of our performance relative to markets. The big thing for us is we want the 2% we're invested in to keep their heads above water because we think some of the 98% won't.
Yeah. Very good. If we've got quickly time, I'll give you a Lego bricks analogy, which was given to me by, I think one of your top stocks is Microsoft, isn't it?
Mm.
And he's the IT, he's quite a senior IT guy in a big FTSE 100 company, and they've just signed their Microsoft cloud agreement. And he said, you imagine when we were using Lego, you would invent something, you'd make it, but to do the next one, you'd have to take the bricks apart and start again.
Exactly.
He said, now imagine the cloud environment that my guys have got. He said, it's like they've got a vending machine pouring Lego bricks every day, and they just build something, put it to one side, build the next thing, put it to one side, and they don't dismantle anything. So the consumption in the cloud just goes up and up and up. And of course, Microsoft is doing incredibly well off that.
Well, it's all the office. And just to take that point, that has implications for his office space because he's not running server rooms. He's not
Correct.
buying the air conditioning kit. He's not buying the computers with the Intel chips. It means that Intel's biggest customers and others in that industry are increasingly big companies they're facing off against, not small companies. And that will have implications for Intel's pricing power. So these things, we talked about the SIFT and the riddle. The other phrase we have is, people say to us, do you have a macroeconomic view? Top down, not a chance. Wouldn't know how to do it. Do you have a view of the global economy? Oh yes, it's a mosaic built stock by stock, like the mosaics at Pompeii. Not all of them, some of them are quite risky, but the mosaics at Pompeii are built stone by stone. And we are trying to build our view of the world stone by stone. And so when we learn from ST Microelectronics, when we learn from Microsoft, when we learn from Alphabet, by the way, Alphabet had a 40% revenue growth in its cloud server business, and they're supposed to be the poor relations behind AWS and Microsoft. So your friend, his decisions are being replicated all around the world. And that has a long way to run. That's what I mean about sustainability.
Absolutely. Good. Well, I think we're nearly done. The only thing was, and I didn't bring it up, but a macro call, which is to just quickly discuss inflation. And actually, you mentioned the DB pension business, and a lot of our clients have come to us having transferred out of DB pensions. And one of the things that they perhaps thought they had was under the DB arrangement was a secure income linked to inflation. But of course, lots of the schemes introduced caps on those inflation increases, and there was an increasing shift from RPI to CPI, and introductions of caps sometimes as low as 2.5–3%.
Yep.
Now, we've just blown through that in RPI, which includes housing costs, which all our customers suffer. So we're 5% above the caps on some of these scheme pension increases, which is an interesting phenomenon. What do you think are your chances of your portfolio keeping up with that 7% inflation versus clearly the DB scheme is capped and has given up, but
yeah,
how will it, I mean, obviously, yeah, you give us your view.
Well, let's start with some simple arithmetic. This question began about a year ago, and initially I got a bit cranky about it because some of the questioning, unlike yours just now, because you went through all the numbers, but some of the questioning came from people who thought there never had been inflation. And just to remind you, the trigger point at which the governor of the Bank of England must write a letter to the Chancellor, or is it to Parliament, or both, is when inflation exceeds 2%. So the tacit inference one makes from that, or the inference one makes from that, is that the UK political system is content with 2% inflation. Well, 2% inflation over 10 years drops the real value of your assets 17%. Who wants a 17% reduction in their assets? So 2% inflation isn't very good. 4% inflation drops you 30% over 10 years. And 6% inflation drops us 43%. So where I was wrong a year ago was slightly to belittle those who were concerned, because they should have been concerned anyway with 2% inflation. Secondly, we know that there is rampant deflation in large segments of the economy and have been for a long time, particularly in the technology sector. And we had this oddity last year of secondhand car prices soaring because the supply chains were disrupted. So some of that may or may not change. So the answer to your question is we are all going to be working very hard. So if we want a real return over inflation of just to get 7%, that means the bar for dividend growth to have an inflation-proof portfolio is 8, 9, 10% per annum dividend growth. Unilever is not going to do that. So yes. The question is, where will it arise? Now, the oil and gas companies might do it for the next year or two, but then there's the question of the sustainability of that over the long term. So my only answer to your question, forgive me, and it's a terrible quote to give, and I'm going to get details wrong. I have nothing to offer you but blood, sweat, toil, and tears. That is the answer. And we will be working to find the 2%. So the heroic assumption we make is that out of the 2,500 stocks, 60 or 70 of them are good enough to have a chance to do that, that we'll sift out the duds, and that we'll invest in those and have the wit to hang on through the occasional air pockets of difficulty, but to let them run out for the long run so that they can deliver that compound return. And as soon as this is finished, I'll get back to it.
Well, I'm going to let you go, Alan. I think that was brilliant, and I hope you've enjoyed it. I thoroughly enjoyed it, and we hope our watchers and listeners enjoy it too. Thank you very much.